Hello everyone, and welcome back to the channel. Today, we're embarking on an ambitious journey. For the next hour, we're going to dissect the wisdom of one of the most intriguing and, at times, controversial figures in financial history, George Soros. But this isn't going to be a biographical deep dive or a look at his most famous trades. Instead, we're going to distill his core intellectual framework, his tips, if you will, into actionable insights that transcend the financial markets and can be applied to decision-making in any complex system. George Soros isn't just a legendary investor, he's a self-proclaimed philosopher. His success wasn't merely due to superior analysis or precedent calls, but to a profound understanding of how markets, and indeed, societies truly operate. He understood that our perceptions influence reality, and reality in turn influences our perceptions, creating dynamic, often unstable feedback loops. This concept, which he termed reflexivity, is the cornerstone of his thinking, and it's where we begin. So, if you're looking for a simple list of stocks to buy or a magic formula, you're in the wrong place. But if you're ready to fundamentally challenge how you view markets, human behavior, and the process of decision-making itself, then stick around. Because by the end of this hour, you'll have a new lens through which to observe the world. A lens forged in the intellectual crucible of George Soros. Let's dive in. Tip number 1. Embrace your inherent fallibility. Understand that your understanding is always flawed. This might sound like a humble starting point, but it's arguably the most fundamental of all Soros's insights. Unlike the prevailing economic theories that posit rational actors and efficient markets, Soros's philosophy begins with a crucial premise. Human understanding of the world is inherently incomplete and often biased. We are fallible creatures, constantly making decisions based on imperfect information and distorted perspectives. Now, why is this so important? Because if you accept your own fallibility, it changes everything. It forces you to question your assumptions, to constantly reevaluate your positions, and to remain open to new information, even if it contradicts your existing beliefs. Think about it. Traditional economics often assumes that if information is available, market participants will quickly incorporate it into rational prices, leading to a state of equilibrium. Soros argues this is a profound mistake. Our interpretations of information are subjective, colored by our biases, emotions, and preconceived notions. In the markets, this means that perfect foresight is impossible. You will be wrong, I will be wrong, everyone will be wrong at some point. The key isn't to avoid being wrong, but to understand why you were wrong, and more importantly, how to manage the consequences of being wrong. This leads directly to a mindset of intellectual humility and a constant search for disconfirming evidence. Soros himself was famous for changing his mind and adjusting his positions, sometimes radically. When new evidence emerged, he didn't cling to a thesis out of ego. He understood that holding on to a flawed understanding, especially when capital is at stake, is a recipe for disaster. So, the first and perhaps most liberating tip from George Soros is this. Acknowledge your limitations. Recognize that your map of reality is never the territory itself. This acknowledgement is the bedrock upon which all his other insights are built. Without it, you'll inevitably fall into the trap of overconfidence and intellectual rigidity. Tip number 2. Master the theory of reflexivity. Understand how perceptions shape reality, and reality shapes perceptions. If fallibility is the foundation, then reflexivity is the architecture of Soros's intellectual edifice. This is the concept he is most famous for, and it's where his philosophical insights truly differentiate him from traditional economic thinkers. Reflexivity, in its simplest form, is a two-way feedback loop between participants' thinking and the actual state of affairs. It's not just that our understanding of reality is flawed, it's that our flawed understanding actively changes that reality. Let's break this down. In many social systems, including financial markets, the participants' thoughts are part of the situation that they are observing. For example, if enough investors believe a stock is undervalued and start buying it, their buying activity drives up the price, confirming their initial belief. Even if the underlying fundamentals haven't changed, this higher price, in turn, might attract more buyers, creating a speculative bubble. This is a positive feedback loop. Conversely, a negative feedback loop can occur. If investors believe a currency is overvalued and start selling it, their selling pressure can cause the currency to fall, validating their bearish view and potentially leading to further selling, even if the underlying economy is relatively stable. This is how boom-bust cycles are born. Soros wasn't content with the efficient market hypothesis, which states that all available information is instantly and perfectly reflected in asset prices. He argued that markets are inherently disequilibria because they are constantly being shaped by the biased perceptions of participants. The very act of observing and acting within the market influences the market itself. Think about a housing bubble. People buy houses because they believe prices will go up. Their buy-in drives prices up. Rising prices reinforce the belief that prices will continue to rise. This creates a self-reinforcing, reflexive process. Eventually, the discrepancy between the underlying value and the market price becomes unsustainable, and the bubble bursts, triggering a reverse reflexive process of falling prices and panic selling. For Soros, recognizing these reflexive feedback loops is paramount. It means that markets are not just passive reflections of underlying fundamentals. They are active shapers of those fundamentals. A strong stock market can make companies more confident, encouraging investment and hiring, which then boosts the economy, which in turn justifies higher stock prices. It's a virtuous cycle, until it isn't. The actionable tip here is to look for these self-reinforcing patterns. Where are the prevailing biases, misperceptions, or widely accepted narratives that are actively shaping market reality? Can you identify positive feedback loops leading to unsustainable booms, or negative feedback loops leading to irrational busts? This isn't about predicting the future with certainty, but understanding the dynamics of how trends evolve and reverse. It's about being aware that your own participation and the participation of millions of others is not merely observing a static market, but actively creating a dynamic one. Tip number 3. Focus on discrepancies and disequilibrium, not equilibrium. Building directly on fallibility and Soros argues that opportunities arise precisely because markets are not efficient and are rarely in a state of true equilibrium. Traditional economics often centers around the idea of markets tending towards equilibrium, where supply meets demand and prices reflect all available information. Soros flips this on its head. He says, the interesting money is made when markets are out of equilibrium, when there's a significant discrepancy between prevailing expectations and the underlying reality, or between how people are acting and what the fundamentals truly dictate. His entire trading philosophy was built on identifying these fault lines or rips in the fabric of reality. He looked for situations where the market's collective understanding, or the dominant narrative, was fundamentally flawed and actively driving reality in an unsustainable direction. Consider his famous bet against the British pound in 1992. Prevailing expectation was that the UK would maintain its position in the European exchange rate mechanism. However, Soros identified a fundamental discrepancy. The British government's economic policies and interest rates were incompatible with maintaining the ERM peg. He saw a fragile equilibrium being propped up by a false premise. By shorting the pound heavily, he capitalized on the inevitable breakdown of this discrepancy, forcing the Bank of England to withdraw the pound from the ERM. The actionable advice here is profound. Stop looking for perfect information or perfectly balanced markets. Instead, train your mind to spot inconsistencies, anomalies, and widely held beliefs that are in fact misconceptions. Ask yourself, what is the widely accepted narrative in this market or sector? Is that narrative truly supported by underlying fundamentals, or is it a self-reinforcing perception? Where is there a significant gap between what people believe is happening and what is actually happening? What are the implicit biases embedded in the current market price? This requires a truly independent mind, one that isn't afraid to go against the consensus. It means doing your own deep analytical work, questioning everything, and having the courage to bet against the crowd when you identify a genuine discrepancy. It's about finding the pressure points in complex systems where reflexivity is likely to create a significant shift. Remember, the biggest profits are often made when you correctly identify a major disequilibrium that the majority of market participants are either unaware of or unwilling to acknowledge. Tip number 4. Risk management is paramount. First, survive, then thrive. While Soros was known for making massive audacious bets, it's a critical misinterpretation to think he was reckless. Quite the opposite. Underlying his aggressive positioning was an unwavering commitment to risk management. He famously said, "My first rule is to survive. My second rule is to survive. My third rule is to survive." For Soros, protecting capital was always the priority, because if you run out of capital, you're out of the game. This isn't just about setting stop losses, though that's certainly part of it. It's a deeper philosophical approach to capital preservation. It means understanding the downside of every trade or investment before you even consider the upside. It means sizing your positions appropriately, never putting yourself in a situation where a single wrong call could wipe you out. Soros was an expert at what he called testing a hypothesis. He would often initiate a position with a smaller size, almost like a probe, to see how the market reacted. If the market moved in his favor, indicating his thesis might be correct, he would then scale up his position aggressively. If it moved against him, he would quickly exit, taking a small loss and moving on. This approach allowed him to participate in large moves while limiting his exposure to significant losses. He didn't marry his ideas. He married the process of continuously validating or invalidating them. Consider the psychological aspect here. Many investors become paralyzed by fear of loss or driven by the thrill of potential gains. Soros understood that emotions are the enemy of good decisions. By predetermining your risk tolerance and having clear exit strategies, You remove the emotional component from your decisions. It's about being disciplined enough to cut your losses quickly, even if it hurts your ego. The actionable takeaway here is non-negotiable. Define your max loss. Before every decision, know the maximum amount you are willing to lose. Position sizing. Never bet more than a small percentage of your capital on any single idea. Be ruthless with losses. If a trade goes against your thesis, exit quickly. Don't hope, don't pray, don't average down on a losing position unless you have a fundamentally new and compelling reason. Focus on the process. Develop a robust decision-making process that prioritizes capital preservation. For Soros, big profits were a consequence of exceptional risk management and correctly identifying not the primary objective. He knew that by protecting his capital, he would always be around to seize the next big opportunity. This counterintuitive focus on defense is a hallmark of truly successful long-term investing. Tip number 5. Be flexible, not stubborn. Don't marry your ideas. This tip is a natural extension of both fallibility and risk management. If you acknowledge that your understanding is always imperfect, and if you prioritize survival, then it logically follows that intellectual rigidity is your greatest enemy. Soros famously said, "It's not whether you're right or wrong, but how much money you make when you're right and how much you lose when you're wrong." This quote encapsulates his extreme emphasis on adaptability. Many investors, and people in general, fall into the trap of cognitive dissonance. Once they've committed to an idea, a narrative, or a position, their ego becomes intertwined with it. They look for confirming evidence and ignore disconfirming evidence. They will cling to a losing position, hoping for a turnaround, rather than admitting they were wrong and cutting their losses. Soros had no such ego. His loyalty was to capital preservation and seizing opportunity, not to being right. He understood that markets are dynamic systems, constantly evolving as new information emerges and as reflexive feedback loops play out. What was true yesterday might not be true today. A brilliant thesis, if overtaken by events, becomes a liability. Therefore, the ability to change your mind quickly, even radically, is a superpower. This flexibility extends beyond simply cutting losses. It means being open to completely reversing your position if the evidence warrants it. Soros wasn't afraid to be a bull one day and a bear the next. If the underlying dynamics shifted, his views were always provisional, always subject to revision. He didn't invest in a stock, he invested in a thesis about a stock. And if that thesis was invalidated, the stock was gone. Actionable takeaways for cultivating this flexibility. Separate ego from ideas. Your personal worth is not tied to your investment outcomes. Set triggers for reevaluation. Before entering a position, decide what conditions would invalidate your thesis and prompt you to exit or reconsider. Seek disconfirming evidence. Actively look for data or arguments that contradict your current beliefs. Review your mistakes. Don't just move on from losses. Analyze them. What did you miss? Where was your understanding flawed? What lesson can you extract? This continuous learning and iterative adjustment process is what allowed Soros to navigate treacherous markets for decades. He was a master of adaptation, constantly refining his understanding and adjusting his sails to the prevailing winds, even when those winds shifted suddenly and violently. In a world of constant change, stubbornness is a fatal flaw. Flexibility is the ultimate competitive advantage. Tip number 6. Think macro, not just micro. Understand the big picture, global dynamics. While individual companies and sectors have their own stories, Soros's greatest triumphs often came from understanding broad, global macroeconomic trends and their reflexive interplay. He wasn't primarily a stock picker who delved into the minutiae of balance sheets. He was a global macro investor who looked at interest rates, currency flows, central bank policies, geopolitical events, and major demographic shifts to identify where the biggest discrepancies and reflexive opportunities might emerge. For Soros, the forest was far more important than the trees. He understood that powerful macroeconomic forces, like shifts in monetary policy, global trade imbalances, or technological revolutions, could create tidal waves that would lift or sink entire asset classes. Regardless of individual company performance, if you're focusing only on micro-level analysis, you might miss the elephant in the room. His famous bet against the pound wasn't just about the UK economy. It was about the broader tension within the European ERM system. His bets during the Asian financial crisis were about understanding the vulnerabilities of pegged currencies in rapidly developing economies and the global capital flows that could exploit those weaknesses. The actionable insight here is to broaden your analytical scope. Read widely, consume news and analysis about global economics, geopolitics, central bank policies, and major industry trends. Identify interconnections. How do changes in one area impact other areas? Look for paradigm shifts. Are there fundamental changes occurring that could alter the long-term trajectory of economies or markets? Don't ignore the irrelevant. A seemingly minor political event in one corner of the world could trigger a cascade of reflexive effects. If it hits a vulnerable spot in the global financial system, this doesn't mean becoming an expert in everything, but it means having a mental framework that acknowledges the interconnectedness of the global economy. By understanding these broader forces, you can better anticipate where the next major disequilibrium might emerge and position yourself accordingly, riding the big waves rather than being swamped by them. Soros's greatest insights often came from spotting the big picture vulnerabilities that most micro-focused investors simply overlooked. Tip number 7. Treat investing as a scientific process. Formulate hypotheses, test them, and be prepared to reject them. Soros, despite his philosophical leanings, approached investing with the rigor of a scientist. For him, a market position wasn't a belief, it was a hypothesis. He would formulate a thesis based on his understanding of fallibility, reflexivity, and macroeconomic trends, and then he would test that hypothesis in the market. This means formulation. Develop a clear, testable thesis. What is the discrepancy you see? How will reflexivity play out? What are the conditions that would prove your thesis right or wrong? Experimentation. Enter the market. Often, as we discussed, this would begin with a smaller, probing position. Observation. Closely monitor market behavior. Is the market confirming your thesis, or is it moving in a way that contradicts your expectations? Analysis and adjustment. If the market confirms your thesis, you might scale up. If it disconfirms it, you must analyze why, extract lessons, and be prepared to exit or even reverse your position. This scientific method directly combats emotional decision. It removes the ego from the equation, because in science, a failed experiment is just as valuable as a successful one. Both provide data and insights. There's no shame in a hypothesis being disproven, only in refusing to acknowledge the evidence. Actionable steps to apply this scientific mindset. Maintain an investment journal. Document your thesis for every major trade. What was your reasoning? What were your assumptions? What was your expected outcome? Define invalidation points. Before you put capital at risk, articulate what conditions would prove your hypothesis wrong. These are your mental stop. Review your performance systematically. Don't just look at P&L. Go back to your journal. Where did your thesis align with reality, and where did it diverge? What errors in your initial assumptions or analysis can you identify? Embrace disconfirming evidence. View any market action against your position, not as a personal affront, but as valuable data challenging your hypothesis. Soros understood that markets are laboratories, and every trade is an experiment. The goal isn't to be always right, but to continuously refine your understanding of how complex systems work through rigorous testing and objective analysis. This iterative process of Tip number 8. Master emotional discipline. Control your fear and greed. This tip might sound like common sense, but its importance cannot be overstated, especially for someone who made such massive high-stakes bets. Soros was acutely aware of the detrimental role emotions play in financial decisions. He acknowledged feeling pain when losing money and exhilaration when making it, but his genius lay in his ability to separate those feelings from his analytical process. Fear and greed are the two most powerful emotions that drive irrational behavior in markets. Fear can lead to panic, selling at the bottom, missing out on rebounds, or being too cautious to seize opportunities. Greed can lead to chasing unsustainable rallies, taking excessive risks, refusing to take profits, or doubling down on losing positions. Soros understood that succumbing to these emotions would inevitably lead to ruin. His solution wasn't to suppress emotions entirely, that's impossible, but to build systems and processes that effectively neutralize their impact on This ties back to the scientific approach and strict risk management. By having clear rules, predefined exit points, and a disciplined approach to position sizing, he created guardrails that prevented his emotions from derailing his strategy. He also had a unique physiological response to being wrong. He often spoke of feeling physical pain, like a backache, when his positions were going against him. Rather than ignore this discomfort, he used it as a signal, prompting him to re-examine his thesis and consider whether he was wrong. It was an intuitive alarm system that complemented his intellectual process. Actionable steps for emotional discipline. Have a plan. Before you enter any trade or make a major investment decision, have a clear plan for entry, exit, and risk management. Stick to it. Automate where possible. Use stop losses, take profit orders, and other automated tools to remove the human element from critical decision points. Review in a calm state. Don't make big decisions during periods of market volatility or emotional stress. Review your portfolio and make adjustments when you are calm and rational. Practice mindfulness. Be aware of your emotional state. If you feel extreme fear or greed, take a break. Step away from the screens. Learn from others' mistakes. Observe how mass psychology plays out in speculative bubbles and crashes. Recognize how emotions amplify reflexive processes. For Soros, emotional discipline wasn't about being emotionless, but about preventing emotions from blinding him to reality. It allowed him to remain objective when others were panicking or getting euphoric, enabling him to make rational decisions in irrational markets. This mastery of self is perhaps the most difficult, yet most rewarding, tip from the Soros playbook. Tip number 9. Develop your own philosophical framework. Don't just follow others. Perhaps the most meta of all Soros's tips is the insistence on developing your own deep understanding of how the world works. Soros didn't just read economic textbooks and apply their theories. He found them largely inadequate for explaining the real-world dynamics of markets. Instead, he developed his own comprehensive philosophical framework centered on fallibility and reflexivity, drawing from Karl Popper's philosophy of science and his own experiences. This personal framework wasn't just an intellectual exercise. It was his competitive edge. It allowed him to see patterns and vulnerabilities that others, operating under different assumptions, simply couldn't perceive. His success was a direct consequence of his ability to think independently and challenge prevailing dogmas. For most people, simply adopting a set of rules or strategies given by someone else is easier. But Soros's approach suggests that true mastery comes from developing your own coherent understanding, your own mental model of reality. This means question everything. Don't accept conventional wisdom at face value. Read widely and deeply. Explore philosophy, psychology, history, and other disciplines that shed light on human behavior and complex systems. Synthesize your learning. Don't just collect facts. Try to connect disparate ideas and form a unified view. Test your own ideas. Apply your developing framework to real-world situations and see if it holds up. Be prepared to modify. Just like his trading positions, Soros was constantly refining his philosophical views as he learned more. This isn't about becoming a philosophy professor, but about becoming a conscious, independent thinker. It's about building a robust internal compass that guides your decisions, rather than relying solely on external signals or popular opinion. When you have a deep, personal understanding of how things work, you can react to unforeseen events with clarity and conviction, while others are simply reacting to the immediate headlines. This commitment to intellectual autonomy is a defining characteristic of George Soros. Tip number 10. Cultivate the ability to find the rip in the fabric of reality. This final tip encapsulates much of what we've discussed, but it adds a layer of intuitive genius that is harder to teach, yet crucial to Soros's success. He spoke of finding the rip in the fabric of reality, referring to those rare moments when the market's collective misconception has diverged so wildly from underlying reality that the system is ripe for a significant, often violent, correction or reversal. This isn't about minor it's about major disequilibrium where a significant shift is imminent due to the reflexive feedback loop reaching an unsustainable point. It requires deep analytical acuity, the ability to see the underlying fundamentals and compare them to market narrative, understanding of reflexivity, recognizing how the misconception itself is shaping reality, making the situation increasingly fragile, patience, waiting for that moment of maximal discrepancy, courage, the willingness to bet against the crowd when that moment arrives, synthesizing intuition and intellect. Soros often spoke of his gut feelings, his backaches, which served as signals. These intuitions weren't random. They were developed over decades of intense intellectual engagement with markets. They were subconscious pattern recognition at work. Finding the rip means identifying situations where a widely held belief is not only wrong but is actively creating a dangerous distortion. Examples include the belief that a certain currency peg can be maintained indefinitely, despite incompatible economic policies. The widespread conviction that housing prices can only go up, fueling a speculative bubble. The idea that certain companies are immune to economic downturns, leading to extreme valuations. When these rips are identified, and the moment of collapse or reversal is near, Soros would bet big. He understood that these major corrections offered exponential opportunities if correctly identified. It's not about being right often, but about making enormous profits when you are right on these infrequent, high-impact trades. This tip is the culmination of all the others. You need fallibility to acknowledge your own potential for error, reflexivity to understand the dynamics of the rip, risk management to survive until you find it, flexibility to act decisively, macro thinking to spot it globally, a scientific approach to test your hypothesis, and emotional discipline to execute without hesitation. Tip number 11. Understand and identify fertile fallacies. This tip is a more specific and nuanced application of the concept of Soros introduced the term fertile fallacy to describe a particularly insidious type of flawed understanding that doesn't just exist, but actively shapes reality in a way that initially validates the fallacy, leading to a self-reinforcing, unsustainable boom. It's a fertile fallacy because it breeds its own initial success before ultimately leading to a bust. Here's how it works. A flawed premise. A significant number of market participants adopts a belief that is fundamentally incorrect or based on an incomplete understanding of reality. Action based on fallacy. People act on this flawed premise. For instance, they believe a company is worth more than its fundamentals, or that an asset class can only go up. Initial validation. The collective actions based on this fallacy cause the price of the asset to rise, or the perceived value to increase. This initial rise seems to confirm the original flawed belief, drawing in more participants. Self-reinforcing loop. This positive feedback loop continues, creating a bubble or a trend that seems unstoppable. The price becomes increasingly detached from underlying value, but the perception of value is being continually reinforced by rising prices. The inevitable collapse. Eventually, the discrepancy between the underlying reality and the inflated price becomes too great. Some external event, or simply the exhaustion of new buyers, punctures the bubble, leading to a sharp reversal, often a panic, as the reflexive process unwinds in reverse. Soros saw the Asian financial crisis in the late 1990s as a prime example of a fertile fallacy. The belief was that rapidly developing Asian economies had found a new paradigm of endless growth, attracting massive capital, and these inflows, in turn, funded projects, inflated asset prices, and made the economies appear to be booming, thus validating the initial belief. But underneath, structural weaknesses were being ignored. When confidence finally wavered, the fertile fallacy unwound with devastating speed. The actionable insight here is crucial. Don't just look for any discrepancy. Look for those where the prevailing belief is actively creating the reality that initially validates the belief. Identify the core fallacy. What is the fundamental assumption that seems too good to be true or lacks robust support from fundamentals? Trace the reflexive loop. How are actions based on this fallacy, reinforcing the fallacy itself? What are the mechanisms? Look for vulnerabilities. What underlying weaknesses are being masked or exacerbated by this positive feedback loop? What could eventually puncture the bubble? This is a deeper level of analysis than simply identifying an overvalued asset. It's about understanding the dynamic process by which a misperception can become dominant and lead to a temporary, but ultimately destructive, period of prosperity. Successfully identifying and betting against fertile fallacies requires immense intellectual rigor and a willingness to stand against what appears to be unassailable momentum. Tip number 12. Master the art of scaling in and out. It's not just about entry and exit. While tip number 4 emphasized risk management and protecting capital, Soros's approach to position sizing was far more dynamic than simply putting on a fixed amount and setting a stop. He was a master of scaling, gradually increasing or decreasing his position size, as his hypothesis was either confirmed or invalidated by the market. This goes beyond simple entry and exit points. It's about managing the size of your exposure over time in response to evolving market signals. Here's the core idea. Initial probe. When Soros first formed a strong hypothesis about a significant disequilibrium or a fertile fallacy, he wouldn't bet the farm immediately. He would initiate a relatively small, probing position. This allowed him to test his thesis without exposing too much capital. It was like putting a toe in the water to gauge the temperature. Scaling up with confirmation. If the market moved in the direction he anticipated, and his thesis began to be confirmed by price action or unfolding events, he would then aggressively scale up his position. This is where he made his vast sums of money, by piling on when his conviction was rising and the market was starting to validate his view. He didn't just add a little, he added a lot. This required immense courage and confidence in his analytical framework, scaling out with invalidation or profit-taking. Conversely, if the market moved against his position, signaling that his thesis might be he would quickly reduce his exposure, taking small losses to protect capital. He was equally aggressive in scaling out of losing positions as he was in scaling into winning ones. He also understood when a trend had reached its reflexive peak and would start to scale out of profitable positions to lock in gains, rather than waiting for the inevitable reversal. This dynamic scaling strategy is a sophisticated form of risk management and profit maximization. Limit early risk. You don't commit a large amount of capital when your conviction is still forming. Maximize gains on conviction. When your thesis is proven correct, you capitalize on it fully. Minimize losses quickly. You don't let small errors become catastrophic. Ride trends effectively. You participate in the full unfolding of a reflexive process, rather than just catching the beginning or end. Actionable application of dynamic scaling. Predetermine entry and exit points for each layer. If you plan to scale in, decide beforehand what market action would trigger additional buys. The same for scaling out. Don't average down on a losing bet. Scaling up means adding to a winning position where your thesis is being confirmed, not doubling down on a losing one out of hope. Be patient for the initial signal. Don't rush into a large position. Wait for the market to give you some initial validation. Be decisive in scaling. Once the signal is clear, don't hesitate. Size matters, and sometimes you need to be aggressive with your position sizing to capture significant moves. Soros's mastery of scaling allowed him to leverage his insights into massive profits, precisely because he was able to concentrate capital, where his understanding of reflexive processes was most acute and being validated by market action. It's about being a sniper with your initial shot, and then a machine gunner when you know you've hit the target. Tip number 13. Embrace chaos and disorder. Opportunities lie in imperfection. This tip underpins Soros's entire outlook. Unlike many who seek order, predictability, and stability in markets, Soros actively thrived in environments of chaos, uncertainty, and disequilibrium. He understood that perfect information and rational actors would lead to efficient markets, leaving no room for exceptional profits. It is precisely the imperfections, the biases, the irrationality, and the disorder of human systems that create the opportunities for extraordinary gains. If markets were perfectly efficient, there would be no rips in the fabric of reality, no fertile fallacies, and no major discrepancies to exploit. Soros viewed market efficiency not as a given, but as a dangerous illusion. He understood that human participation, driven by fallibility and subject to reflexive feedback loops, inherently injects instability and unpredictability into the system. Therefore, rather than being intimidated by chaotic conditions, Soros sought them out. He wasn't afraid of volatility. He saw it as a sign of significant reflexive processes at play, potentially creating opportunities for large swings. While others might retreat during periods of high uncertainty, he would be sharpening his analytical tools, looking for the underlying fertile fallacy, or the emerging discrepancy that the chaos was revealing. This mindset requires a unique psychological disposition. Comfort with uncertainty. Acknowledge that the future is inherently unknowable and embrace that reality. Your goal isn't to predict, but to adapt and respond. Discomfort with consensus. If everyone agrees, there's usually no opportunity left, and perhaps a collective fallacy is at play. Analytical rigor in volatility. When emotions are running high and prices are swinging wildly, maintain your intellectual discipline and stick to your framework of fallibility and seek out vulnerabilities. Chaos often exposes weak links in systems, creating the very rips Soros looked for. Actionable steps to embrace disorder. Educate yourself on nonlinear systems. Study complexity, theory, chaos, theory, and behavioral economics to better understand how irrationality and feedback loops drive real-world systems. Avoid dogmatic beliefs. Don't cling to rigid models or ideologies that assume perfect rationality or stability. Develop a crisis playbook. Think about how you would react to various extreme market scenarios before they happen, so you can execute rationally when fear or greed takes over. Practice independent thinking. The more you can detach from consensus thinking and process information through your own unique framework, the better equipped you will be to navigate and profit from disorder. For Soros, the market was a constantly evolving, inherently imperfect, and often irrational beast. Instead of fighting its nature, he learned to understand it, appreciate its flaws, and capitalize on the opportunities those flaws presented. This acceptance of disorder and the courage to operate within it was a cornerstone of his extraordinary success. Tip number 14. Identify and challenge the dominant narrative or prevailing bias. This tip is a deeper dive into applying reflexivity and spotting fertile fallacies. Soros understood that in any given market or social system, there's usually a dominant narrative, a widely accepted story, belief, or consensus view that shapes how participants perceive reality. This narrative, however, is often a bias, a skewed or incomplete understanding, and it actively influences reality in a reflexive loop. For example, in the lead-up to the dot-com bubble, the dominant narrative was new economy, old metrics didn't apply, and internet companies would grow infinitely. This narrative, while flawed, encouraged investment, which pushed up stock prices, which seemingly validated the narrative, attracting more investment. This self-reinforcing cycle was driven by a powerful, albeit biased, story. Soros's genius lay in his ability to step outside this dominant narrative, question its underlying assumptions, and identify its inherent flaws. He sought to understand how this narrative was influencing behavior and where it was leading to an unsustainable disequilibrium. He wasn't just looking for undervalued assets. He was looking for over-accepted narratives that were creating overvalued realities. Actionable steps to apply this. Listen to the consensus. Pay close attention to what everyone is saying, what stories are pervasive in the media, and what beliefs are almost universally accepted. Question the unquestionable. For each dominant narrative, ask, what are its underlying assumptions? Are they truly sound, or are they based on incomplete information or wishful thinking? Look for contradictions. Where does the narrative clash with hard data, historical precedent, or fundamental economic principles? Identify the feedback loop. How is this narrative influencing behavior, and how is that behavior reinforcing the narrative itself? What makes it fertile? prepare to bet against it. Once you've identified a flawed, dominant narrative driving an unsustainable reflexive process, cultivate the intellectual courage to take a contrarian position. This isn't about being contrarian for contrarianism's sake. It's about being contrarian when the consensus is demonstrably flawed and actively shaping an unsustainable reality. It's a core application of reflexivity, demanding an independent mind willing to challenge widely held beliefs. Tip number 15. Use discomfort as a signal. This might sound unusual, but Soros frequently spoke about experiencing a backache or a general sense of physical unease. When he was wrong about a market position, he didn't dismiss these feelings as mere stress. He trained himself to interpret them as crucial signals. For Soros, physical discomfort was often a subconscious alarm bell, telling him that his intellectual framework was clashing with reality, and that he needed to reevaluate his position immediately. Most people try to ignore or suppress feelings of discomfort, especially when losing money. They attribute it to stress or bad luck. Soros, however, saw it as valuable, albeit uncomfortable, data. It was his internal warning system, signaling that his understanding might be flawed, or that the market was reacting in a way he hadn't anticipated. This allowed him to cut losses quickly, before they became catastrophic, and to pivot when necessary. This tip bridges the gap between the purely intellectual and the intuitive. While Soros emphasized rigorous analysis, he also recognized that our bodies can sometimes pick up on subtle cues that our conscious minds haven't yet fully processed. Actionable application: pay attention to your body when making significant financial decisions or when a position is going against you. Notice any physical sensations of unease, tension, or discomfort. Don't ignore your gut. While pure emotion is dangerous, a strong gut feeling might be your subconscious mind telling you something important. Treat it as a hypothesis to be investigated, not a definitive answer. Use discomfort as a trigger for reevaluation. If you feel that backache, don't double down out of stubbornness. Instead, take a step back, review your thesis, and actively look for disconfirming evidence. Ask yourself, what if I'm wrong? What am I missing? Separate signal from noise. Learn to differentiate between genuine, insightful discomfort and simple fear or anxiety. This requires practice and This unique insight highlights Soros's holistic approach to where intellectual rigor was complemented by a profound self-awareness and an almost scientific use of his own internal state as a data point. Tip number 16. Understand the fallibility of policymakers and institutions. While Soros critically analyzed market participants, his macro trades often hinged on an equally important insight: the fallibility of governments, central banks, and international institutions. Traditional economic models often assume that policymakers are rational, omniscient actors who will always make the right decisions to achieve stability. Soros knew this was a dangerous assumption. Policymakers, just like market participants, operate under incomplete information, personal biases, political pressures, and their own limited understanding of complex systems. Their decisions can be based on flawed models, dogmatic ideologies, or a refusal to acknowledge reality. And crucially, their actions can also create reflexive feedback loops. Consider currency pegs. A central bank decides to fix its currency to another. The market, trusting the central bank, might initially believe this peg is sustainable. Capital flows in, validating the peg, but if the underlying economic conditions are incompatible with the peg, the central bank might be wrong in its policy. In its efforts to maintain, the peg will become increasingly futile and costly. Soros's bet against the pound was fundamentally a bet against the Bank of England's ability or willingness to maintain an unsustainable policy. Actionable takeaways. Analyze policy through a fallibility lens. When you hear about government or central bank policies, ask, what are their assumptions? Are those assumptions sound? What are the potential unintended consequences? Look for incompatibilities. Are the stated policy goals compatible with the underlying economic realities? Is the central bank trying to fight an inevitable tide? Identify the policy bias. Do policymakers have a particular ideological lean or a vested interest that might blind them to certain realities? Anticipate policy shifts. Understand that policymakers are also part of the reflexive process. Market reactions can force them to change their policies, which then creates new opportunities. Be skeptical of official narratives. Just like market narratives, official statements from institutions can also be part of a fertile fallacy, designed to maintain confidence in an unsustainable situation. Soros understood that big money could be made, not just from market participants being wrong, but from the powerful institutions influencing those markets being wrong and then being forced by market pressures to correct their course. Tip number 17. When in doubt, stay out. In a world that often rewards constant action and engagement, Soros was a master of patience and inaction. He wasn't always trading. He was often waiting, observing, and refining his understanding. He famously said, "I'm only rich because I know when I'm wrong. I basically have survived by recognizing my mistakes. A key part of this survival strategy was avoiding unnecessary risk and not forcing trades when clarity was lacking. Many investors feel compelled to always be in the market, fearing they'll miss out on a move. This leads to taking positions based on weak convictions or hope, rather than solid analysis. Soros knew that such actions would erode capital. If he couldn't identify a clear discrepancy, a compelling reflexive process, or a rip in the fabric of reality, he simply wouldn't participate. Sometimes, the best investment is no investment at all. Sometimes, the most prudent action is to step aside, preserve capital, and wait for a truly high conviction opportunity to emerge. This requires immense discipline, especially when others are making money all around you. Actionable application, clarity is key. Don't enter a position unless you have a clear, testable thesis based on your framework. If your reasoning is fuzzy, the trade is probably fuzzy. Patience is a virtue. The best opportunities don't come every day. Be willing to wait for them, even if it means prolonged periods of inactivity. Cash is a position. Holding cash isn't just about safety. It's a strategic position that gives you flexibility and optionality to deploy capital when clear opportunities arise. Avoid FOMO. Don't let the actions of others or sensational headlines push you into trades you don't fully understand or believe in. Know when to retreat. If a market becomes too chaotic, too unpredictable, or your thesis becomes invalidated, it's often best to exit and reassess from the sidelines. Soros's discipline in discerning when to engage and when to retreat was as crucial to his success as his ability to identify opportunities. It highlights that capital preservation isn't just about cutting losses, it's about avoiding unnecessary exposure in the first place. Tip number 18. Leverage is a tool, not a goal. Use it responsibly with high conviction. George Soros used leverage aggressively, amplifying his bets to astronomical levels. However, it's critical to understand that for Soros, leverage was never an end in itself, or a means to force a trade. It was a powerful tool deployed only when he had high conviction. His analytical framework had led him to a strong, testable thesis, clear risk management. He understood the downside, had predetermined exit points, and was prepared to cut losses quickly. Identified a significant discrepancy. The opportunity had to be large enough to warrant the increased risk. Many retail investors use leverage to chase small gains, or worse, to try and recover losses, which is a recipe for disaster. Soros viewed leverage as a magnifier. It magnifies profits when you're right, but it equally magnifies losses when you're wrong. Therefore, it demanded an even stricter adherence to his core principles of risk management and the scientific method of testing hypotheses. He leveraged his capital to capitalize on those rare, high-impact rips in the fabric of reality that he could identify. He didn't leverage every trade. He leveraged his best ideas, those where his philosophical framework gave him a deep, contrarian insight into a major disequilibrium. Actionable takeaways. Leverage only your highest conviction ideas. Don't use leverage on speculative or uncertain trades. Save it for opportunities where your analysis is exceptionally strong. Understand the downside amplification. Be acutely aware that a small percentage move against you can lead to large capital losses with leverage. Combined with strict stop losses, leverage makes stop losses even more critical. Your margin for error is significantly reduced. Focus on the thesis, not just the leverage. The leverage is there to amplify a correct thesis, not to make a weak thesis profitable. Don't use leverage to force returns. If you feel compelled to use leverage just to meet a return target, you're likely taking on excessive risk. Soros's use of leverage was a demonstration of extreme confidence in his analytical process, coupled with an ironclad commitment to cutting losses. It's a testament to the fact that when a truly independent mind identifies a profound market anomaly, acting decisively and with appropriate scale can lead to disproportionate returns. Tip number 19. Cultivate an anticipatory framework. Don't just react. Soros wasn't merely reactive to market events. He actively sought to anticipate how reflexive processes would unfold. This isn't about predicting the future with certainty, but about building a mental framework that allows you to see the dynamic trajectory of a situation. It's about understanding not just what is happening, but what could happen given the prevailing biases, policies, and feedback loops. His anticipatory framework was built on deep understanding of reflexivity. He knew how perceptions would influence reality, and vice versa. He could visualize the positive and negative feedback loops, macro analysis, understanding global flows, central bank reactions, and geopolitical shifts, fallibility of participants and policymakers, anticipating how their flawed actions would create further historical precedent. While every situation is unique, patterns of human behavior and market bubbles, busts, recur. This allowed him to mentally play out scenarios, anticipating how a fertile fallacy might evolve, how a policy might fail, or how a crisis might cascade through the system. He wasn't predicting exact dates or prices, but the sequence of events in the direction of the reflexive process. For example, when looking at a currency peg, he would anticipate how interest rate differentials, inflation, and capital flows would put pressure on the peg, how the central bank would react, and how the market would then react to those reactions. It was a multi-layered, dynamic forecast. Actionable application. Scenario planning. For any major market or investment, think through multiple possible future scenarios. Don't just focus on your preferred outcome. If X, then Y thinking. Practice thinking in terms of conditional probabilities and sequences. If this policy is implemented, then how will the market react? And how will that reaction then influence the next policy decision? Identify critical junctures. What are the key data points, policy announcements, or events that could trigger a significant shift in the reflexive process? Update your framework continuously. As new information emerges, refine your anticipatory model. It's a living, breathing framework. Soros's ability to see around corners wasn't magic. It was the result of a rigorous, dynamic, and philosophically grounded understanding of how complex human-driven systems evolve over time. He wasn't just reacting to the game, he was thinking several moves ahead. Tip number 20. The pursuit of truth is dynamic and iterative. Never stop learning and adapting. This final tip encapsulates Soros's overarching intellectual approach. For him, understanding reality was not a static goal, but an ongoing, never-ending process. He didn't believe in a fixed, objective truth that, once discovered, would remain constant. Instead, he saw reality, especially social reality, as being constantly shaped by imperfect understanding and reflexive interactions. Therefore, his own philosophical framework, fallibility and reflexivity, was itself subject to continuous refinement. He was always reading, debating, thinking, and testing his ideas against the unfolding events of the world. He understood that rigidity in thinking was as dangerous as rigidity in trading. This constant pursuit of a more accurate, albeit always incomplete, understanding is what allowed him to remain at the forefront of financial markets for decades. He never settled into a comfortable dogma. He remained intellectually curious, critical, and humble about his own limitations. Actionable takeaways for life and investing. Embrace lifelong learning. The world is constantly changing. What worked yesterday might not work tomorrow. Stay curious and open to new ideas. Question your own truths. Regularly, challenge your deeply held beliefs, especially those that have brought you success in the past. Are they still relevant? Are they still accurate? Seek diverse perspectives. Surround yourself with people who think differently and can challenge your assumptions. Actively solicit disconfirming opinions. Learn from every experience. Both successes and failures offer invaluable lessons. Don't just celebrate wins or lament losses. Analyze them to deepen your understanding. Stay agile. The ability to pivot, adjust, and fundamentally change your mind is a hallmark of intellectual maturity and continuous adaptation. In essence, George Soros's greatest tip is to become a perpetual student of reality, armed with a powerful, yet flexible, intellectual framework. His extraordinary success wasn't just about making money. It was about the continuous journey of understanding a complex, often chaotic world, and using that evolving understanding to navigate its imperfections. It's about building a mind that is constantly questioning, constantly refining, and always ready to adapt to the ever-changing truth. Tip number 21. Recognize and profit from the anatomy of a bubble. While we've discussed fertile fallacies generally, Soros had a particular expertise in identifying and profiting from financial bubbles. For him, a bubble is the quintessential example of a reflexive process driven by a fertile fallacy. It's not just an asset getting overpriced. It's a dynamic, self-reinforcing cycle of rising prices based on a flawed belief that ultimately becomes unsustainable. The anatomy of a Sorosian bubble typically involves an underlying trend. There's usually a grain of truth, a genuine innovation, or a legitimate growth story that gets the ball rolling. A misconception, bias. This initial trend gives rise to a flawed belief that becomes widespread. This time, it's different. Prices can only go up. New paradigm. Positive feedback loop. Acting on this misconception, more and more people by driving prices higher. The rising prices seem to confirm the misconception, drawing in even more buyers. Credit expansion. Often, this positive feedback loop is amplified by increasing credit and leverage, which makes it easier for people to buy, further inflating prices. Increasing detachment from fundamentals. As the bubble inflates, prices become increasingly divorced from any underlying fundamental value. The inevitable crash. Eventually, the supply of new buyers dries up, or a trigger event punctures the illusion. The reflexive process then reverses, leading to panic selling and a sharp decline as the fallacy unwinds. Soros understood that you don't necessarily have to short the top of the bubble. Sometimes, the most profitable phase is recognizing its formation and then identifying the trigger point for its reversal. or even riding the initial part of the bubble if you understand its dynamics and can exit before the collapse. Actionable application. Look for this time, it's different narrative. This is a classic warning sign of a fertile fallacy. Identify the underlying bias. What are people fundamentally wrong about in their collective understanding? Monitor credit expansion. Is there an excessive increase in leverage or easy credit fueling the asset price appreciation? Track speculative behavior. Are people buying purely based on price appreciation rather than fundamentals? Are new, inexperienced investors entering the market en masse? Anticipate the trigger. While impossible to time perfectly, consider what events or changes could burst the bubble. Don't be afraid to be early. You might be early in identifying a bubble or its collapse. But if your thesis is sound, patience and disciplined risk management are key. For Soros, bubbles were not anomalies, but inherent features of human fallibility and reflexivity in action, offering some of the most significant opportunities for profits if understood correctly. Tip number 22. Practice radical self-criticism and intellectual humility. This tip is perhaps the most personal and challenging, yet fundamental to Soros's enduring success. He was famous for being brutally self-critical, constantly questioning his own ideas and admitting his mistakes. This isn't just about cutting losses, it's about a deep intellectual honesty that prevents ego from clouding judgment. Many people find it difficult to admit they are wrong, especially in public or when significant capital is at stake. They cling to narratives, rationalize bad decisions, and seek confirming evidence. Soros did the opposite. He actively sought out reasons why he might be wrong, considering disconfirming evidence as more valuable than confirming evidence. He viewed mistakes not as failures, but as opportunities to learn and refine his understanding of reality. His self-criticism was directly tied to his concept of fallibility. If our understanding is always flawed, then continuous self-correction is not just advisable, it's essential for survival and growth. This intellectual humility allowed him to remain flexible, change his mind, and pivot his positions without emotional baggage. Actionable application. Maintain a mistake log. Don't just record your winning trades, document your losing trades or incorrect analyses. What was your original thesis? What went wrong? What did you learn? Actively seek contradictory views. Don't surround yourself only with yes. Engage in robust debates with people who hold different perspectives. Challenge your assumptions. When you're most confident about a position, that's precisely when you should spend extra time trying to poke holes in your own reasoning. Separate your identity from your ideas. Your worth as a person is not tied to the accuracy of your predictions or the profitability of your trades. This detachment makes self-criticism easier. What if I'm wrong? Exercise. Before making a big decision, dedicate time to imagining scenarios where you are completely wrong. How would you know? What would you do? Radical self-criticism is the engine of continuous learning and adaptation. It transforms errors from debilitating blows to valuable data points, allowing you to iterate and improve your decision-making process over time. Soros's relentless self-scrutiny was a key factor in his longevity in a notoriously unforgiving profession. Tip number 23. Understand the political and geopolitical dimensions of markets. For Soros, markets are not isolated economic phenomena. They are deeply intertwined with political realities, geopolitical shifts, and the actions of states. He didn't just analyze interest rates and company balance sheets, he factored in elections, regulatory changes, international relations, and the political will of governments and central banks. Many of his most significant macro trades were predicated on an understanding of how political pressures and geopolitical events would influence economic policy, which in turn would create reflexive feedback loops in markets. His bet against the British pound was as much about the UK's political commitment to the ERM as it was about economic fundamentals. His involvement in emerging markets during the Asian financial crisis was also heavily influenced by the political vulnerabilities of those countries. Politicians and policymakers, like market participants, are fallible and often act based on incomplete information or political expediency. Their actions can create or exacerbate disequilibria that a purely economic analysis might miss. A sudden election result, a change in government, or an international dispute can radically alter market perceptions and trigger powerful reflexive processes. Actionable application. Go beyond economic headlines. Read widely on international affairs, domestic politics, and social trends. Analyze policymaker incentives. What are the political pressures on leaders? What are their electoral cycles? How might these influence their economic decisions? Look for political fallacies. Are there widely held political beliefs or policies that are fundamentally flawed and could lead to market instability? Consider geopolitical risks. How might conflicts, trade wars, or shifts in alliances impact global capital flows, commodity prices, or investor confidence? Factor in regulatory environments. How might changes in regulation affect specific industries or the broader market? Soros understood that market forces and political forces are constantly interacting, creating a complex, reflexive dance. Ignoring the political dimension is to operate with a dangerously incomplete map of reality. The biggest rips often emerge at the intersection of flawed economic policies and shifting political landscapes. Tip number 24. Seek out and capitalize on turning points, not just established trends. While Soros would ride trends aggressively when they confirmed his thesis, his true genius often lay in identifying the turning points. The moments when a prevailing trend was about to reverse or when a disequilibrium had reached its peak, he wasn't afraid to be early in calling a top or a bottom, even if it meant initial losses, because he understood the immense profits to be made from catching a major reversal. Turning points are where reflexive processes exhaust themselves and begin to unwind. A positive feedback loop, having inflated a bubble, eventually runs out of new buyers. A negative feedback loop, having driven an asset to extreme lows, eventually exhausts sellers. Soros looked for the signs of these reversals. The dominant narrative becomes universal. When everyone believes the same thing, and the fertile fallacy is fully embraced, it's often a sign of an impending peak. Policy, intervention, governments, or central banks might intervene, either successfully or unsuccessfully, altering the dynamics. Exhaustion of the trend, the rate of change slows down, volumes dwindle, or there's a failed attempt to push prices higher, lower, sudden disconfirming events. Piece of news or an event that directly contradicts the prevailing narrative can trigger a sharp reversal. Catching turning points is difficult and counterintuitive, as it often means going against strong momentum. It requires intellectual courage, precise analysis of the reflexive dynamics, and disciplined risk management for initial probing positions. Actionable application. Identify the limit of the reflexive process. How much further can this positive or negative feedback loop realistically go? What would cause it to exhaust itself? Look for divergences, or indicators diverging from the current price action. Study historical reversals. Understand the patterns and psychological dynamics that accompany major market tops and bottoms. Be patient for the trigger. While you can anticipate a turning point, wait for some initial market action to confirm your thesis before committing significant capital. Except being early, you will likely be early on some of your calls. The key is to manage the interim losses and be prepared to scale in when the reversal truly begins. Soros understood that truly exceptional returns often came from being early and correct about a major shift. Rather than simply following the crowd, this requires a deep understanding of market dynamics and the courage to act when consensus is at its most entrenched. Tip number 25. Acknowledge both skill and luck, and optimize for their interaction. Soros, while undeniably brilliant, was far too intellectually honest to attribute all his success purely to skill. He explicitly acknowledged the role of luck, particularly in the short term, and the randomness inherent in complex systems. However, his genius was in understanding how to optimize for the interaction between skill and luck. He believed that skill allowed him to identify opportunities with a better than random chance of success, but luck determined the exact timing and magnitude of the outcomes. His approach was designed to maximize the upside of good luck by aggressively scaling into winning positions. He was positioned to capture large gains when random events aligned in his favor, minimize the downside of bad luck by ruthlessly cutting losses. He protected his capital from random adverse events. This means not confusing a lucky win with a skilled trade, and not letting a string of bad luck deter you from a sound process. It's about maintaining a robust process that allows you to capitalize when luck is on your side and survive when it isn't. Actionable application. Don't get overconfident with wins. Just because a trade worked out doesn't mean your initial thesis was perfect. Analyze why it worked, including any lucky elements. Don't get demoralized by losses. A losing trade doesn't necessarily mean your process is flawed. Analyze the loss to understand if it was due to a flawed thesis or simply bad luck. Focus on your process. Consistent application of a sound decision is how you increase the probability of favorable outcomes over the long term. Embrace volatility. While random, volatility creates the large moves that skill can exploit. Manage risk to stay in the game. If you can survive periods of bad luck, you'll be around for when your skill and good luck eventually align. Soros understood that success in markets was a probabilistic game, not a deterministic one. His method was designed to stack the odds in his favor, allowing him to benefit disproportionately from positive randomness, while mitigating the impact of negative randomness. Tip number 26. The market is not a rational agent. It's a collection of flawed individuals. This is a core philosophical distinction that underpins everything Soros did. In traditional economic theory, the market is often treated as an abstract, rational entity that efficiently processes information and allocates resources perfectly. Soros vehemently disagreed. He saw the market as a collective of millions of individual participants, each with their own biases, emotions, incomplete information, and fallible understandings. Therefore, market prices are not always efficient reflections of underlying value. Instead, they are the result of this collective, often biased, decision-making process, which then reflexively influences the underlying reality. The wisdom of the crowd can quickly turn into the madness of the crowd when a fertile fallacy takes hold. Understanding this distinction allows you to look for behavioral anomalies. Instead of assuming rational behavior, look for areas where collective human psychology is driving prices away from fundamentals. Identify herd mentality. Where is the crowd moving together? And what might be the flawed premise driving that movement? Capitalize on fear and greed. These powerful human emotions are precisely what create the bubbles and busts that Soros exploited. Don't assume market efficiency. Don't let high prices automatically mean something is valuable, or low prices mean something is worthless. Always question the collective judgment. Actionable application. Study behavioral economics. Learn about cognitive biases, heuristics, and groupthink. Analyze sentiment. Pay attention to market sentiment indicators, not just fundamental data. Is the crowd extremely bullish or bearish? Look for panic and euphoria. These are signs that emotions are overriding rational judgment. Focus on the discrepancy. The gap between the market's collective judgment and the underlying reality is where opportunity lies. Develop independent thought. The more you can think for yourself and resist the pull of the herd, the better equipped you will be to exploit market inefficiency. Soros' success was rooted in his deep understanding of human nature and its He didn't fight the irrationality of the market. He sought to understand its patterns and profit from its predictable irrationality. And there you have it. 29 distinct, yet interconnected insights drawn from the extraordinary mind of George Soros, culminating in his overarching philosophical pursuit. What we've explored today isn't a mere list of trading tactics. It's a profound framework for understanding complex systems, a lens through which to view not just financial markets, but society itself. From embracing your own fallibility and mastering reflexivity, to the paramount importance of risk management, and the relentless pursuit of knowledge. Soros's wisdom offers a robust guide for navigating uncertainty and making better decisions in a constantly evolving world. His success wasn't accidental. It was the direct result of a unique philosophical stance rigorously applied. By integrating these principles into your own thinking, you can begin to see the rips in the fabric of reality. Cultivate the discipline to act when opportunities arise, and ultimately, embark on your own journey of continuous learning and adaptation. Thank you for joining me on this deep dive. I hope this hour has provided you with a new perspective, challenging your assumptions and empowering you to think more critically about the forces that shape our world.